We're back, visited as we have the privilege of being each week by Gordon Chang, one of the country's foremost experts on Asia, having just returned therefrom. As a matter of fact, we're very anxious to catch up with him on developments, particularly with respect to the Chinese economy. First, the stock market, and then there will be some new data delivered by the Chinese government about the economy more generally Wednesday of this week. Gordon, thanks so much for joining us. It's always great to have you with us.
Thank you so much, Frank.
Well, you were there in Hong Kong for some of the perils of Pauline, the roller coaster ride. You saw some of the crashing of the Chinese stock market. It has rebounded to a considerable degree, thanks, I guess, to a lot of Chinese government intervention. You I think, have written that the Chinese have made it illegal for stock shares to lose value. Is that right? And is that how they've turned this thing around? And what does it mean?
Yes. On Thursday, Friday, and Monday, today, the Chinese stock market rebounded. But it was not because of popular pressure from investors wanting to get in. It was because of a couple things. One of them is that, first of all, the Chinese central government essentially banned selling by many market participants and actually required them to buy shares. And also because of stopping initial public offerings and other things. And finally, the Chinese central government itself was a heavy buyer in the market. So what it's done is it has ended the panic, but it has also frozen the stock market. So China essentially no longer has functioning stock markets, and it's about to freeze the financial system and the economy entirely because of what it's been doing in the stock markets. This is going to be especially interesting because this could be even more dangerous than a declining equity prices.
You know, I'm reminded of a term that I believe Vladimir Putin has coined to describe his kind of government as, quote, managed democracy, unquote. This sort of sounds like managed capitalism, or maybe mismanaged capitalism, Gordon Chang. Is it possible that the Chinese can keep this thing going if they're freezing both the market capitalist mechanisms of the stock market and the economy more generally?
They can postpone symptoms. They're very good at doing that. But unfortunately for them, the underlying imbalances become bigger, and that's exactly what's happening in the Chinese economy right now. On Wednesday, we're going to see figures for June, and in other words, for the first half of the year. The preliminary indications have not been good. We've seen the 39th straight month of decline in factory prices. That was already released last week. Also, the trade data indicates that trade volume was down 6.1% for the first half. That's not good because the government's target is for an increase of 6% in trade volume. Many people are thinking the Chinese economy will drop below the 7% figure. It's already there, but the question is, what will Beijing admit to? We're going to find out a lot about their psychology, and this comes at the same time that investors are panicking about the stock market. And so, essentially we have the convergence of two very important trends, nervous investors plus the new indications for the way the economy performed for the first half.
We're speaking with Gordon Chang, the prescient author of The Coming Collapse of China. He is also a columnist at Forbes.com and WorldAffairsJournal.com. He is frequently a guest at Fox News and every week a guest with us, I'm very pleased to say. Gordon, this really sounds as though it's probably not going to be evident from the data that the Chinese government will release on Wednesday. These developments are relatively recent, or do you expect to see significant indications of the impact that this turbulence is having on the Chinese economy?
Yes, I think we will, especially when we start to see July data. And I think that essentially what's going to happen is there are going to be two very important months, July and August, as we see the Chinese economy progress, as we see people trying to sell their shares and the freezing of the financial markets. Because once China freezes, its banking system and its stock markets, then a lot can go wrong very quickly. And basically, Beijing is going to have to scramble again. So there's going to be a series of smaller crises going forward, and it's going to be, I think, worse for China than if they had let prices decline. They might have wanted to stop the panic, but they should allow prices to decrease because that's where the market wants to go. That's where the market will go. And for them to prevent this really is going to cause bigger problems for them in the longer run. And that's really been the history history of their interventions. They've always made problems delayed into the future, but bigger.
Yeah, as you say, it's a symptomatic treatment, and typically that doesn't address the underlying causes of the malignancy and thereby makes it worse. Gordon, let me ask you, we talked last week briefly in connection with another economic basket case, namely Greece, about a proposal that Xi Jinping, the president of China, has been advancing of a new Silk Road connecting China to the West. Talk a little bit more about the strategic sort of considerations at work here, and notably in terms of what China is trying to put into place along the trail, as it were.
Yeah, there are two trails. One is a maritime one, and one is a land route, but they both connect China to Europe through the Middle East and Africa. And the idea is China wants to dominate these routes. So it's basically indicated it's going to spend about $1 trillion on building this infrastructure. The idea is that China right now has too much industrial capacity. It cannot absorb it. It needs to export it, and their exports have been having problems recently. What they like to do is develop new markets and to be able to sell the stuff that they produce. Now, excuse me, this is not really an economic strategy for them, because by the time that they put this into place, if they can, China's economy will have been disappeared, largely because of the crises that they cannot postpone further. But nonetheless, it's interesting in the way that their ambitions are very, very large.
They are very large indeed. That doesn't even take into account space, which is a whole other story. But Gordon, to come back to one of our favorite themes, and that is the Chinese military and its role in all of this, specifically the dependence of the Communist Party on it to support them, and the various opportunities that the military has as a result to expand its capabilities and act belligerently, for that matter. With all of this in the background, President Obama last week declined to receive a top Chinese general, Fan Changlong. What was that about? This is very unusual, it seems to me, for the Obama administration. It's been, I guess, unprecedented with previous administrations as well. Is that right?
President Obama turned down a request by the Pentagon that he meet with General Fan, who is a vice chairman of the Central Military Commission. This was the first time in at least 2 decades, and maybe in history, that a sitting American president refused to meet with a visiting vice chairman of the CMC. And also, interestingly, and this I think is even more intriguing, General Fan